Let's talk about TV for a second. It used to be pretty simple to make money from it. But those days, they're kind of gone. Making a profit from traditional cable is getting tougher and tougher. So what if the answer to this massive, global problem was coming from a place you might not expect?
I mean, think about it. The whole game has changed completely. We're not all huddled around the family TV anymore, right? We're streaming on Netflix, binging on YouTube, watching on our smart TVs, everywhere. And for content creators, that's a huge headache. How do you get your show on all those different platforms? And maybe more importantly, how do you actually make any money from it with ads that people will actually see?
Well, right on cue, an Indian software company is stepping up to the plate. It's called Amagi Media Labs, and they're launching this huge IPO because they're pretty sure they've cracked the code on how to make money from media in this new streaming world.
So, here's what we're going to do. First up, we'll break down what Amagi actually is. Then, we'll get into the good stuff, the reasons you might want to invest. After that, we got to look at the flip side, the risks. And finally, we'll try to make sense of the valuation and give you our final take. Let's dive in.
Okay, so first things first. What is Amagi Media? Well, the simplest way to think about them is as a kind of invisible bridge. They're the connection between the shows you want to watch and the screen you're watching them on.
All right, so here's how it all works step by step. It all starts with the big content owners. We're talking giants like Fox or Network 18. They've got the shows. Amagi then takes that content and uses its cloud software to schedule it and stream it out, basically creating a live channel. That channel then pops up on things like Roku or your smart TV. But here's the real magic, step 4. Amagi's system lets advertisers slot in targeted ads. And that's how everyone makes money. Amagi basically handles the entire super complex process and makes it look easy.
Okay, so you get the business model. It sounds pretty smart, right? So let's look at why this might be a really compelling investment. Let's build the bull case.
The very first thing that just jumps off the page is their growth. I mean, wow. The company's revenue is growing by more than 30% every single year. That is a seriously strong number, and it tells you there is huge demand for what they're selling.
And this number right here, this explains why that growth is so powerful. A 127% net dollar retention rate. Okay, what on earth does that mean? It's actually pretty simple. It means that for every $100 they made from their customers last year, they made $127 from those exact same customers this year. So people aren't just staying, they're actually spending 27% more. That's a huge sign that their product is becoming absolutely essential to their clients.
So when you put it all together, the argument for Amagi rests on a few really solid pillars. They're working with the biggest names in media, their revenue growth is just fantastic, their customers clearly love them and keep spending more, and maybe the most important part, they're growing efficiently. Their costs are going up slower than their revenue, and that, my friends, is the classic recipe for a profitable future.
But it's never that easy. Every great story has some risks, and you absolutely have to look at the other side of the coin. So let's get into the bear case for Amagi.
The first big red flag is concentration. Look at this. A whopping 73% of Amagi's money comes from just one country, the United States. Now that's great while the US market is hot, but it also makes them incredibly vulnerable. If ad spending in the US slows down or tech budgets get slashed, Amagi is going to feel that pain hard.
And it's not just about geography. The concentration risk continues with their customers. Get this. Over 40% of their revenue comes from just their 10 biggest clients. So while it's amazing they have these big contracts, it's also a huge risk. If they lose just one of those major clients, it could put a serious dent in their financials.
And there's more. Amagi's entire business lives on the cloud, mostly on Amazon Web Services. That means if AWS decides to jack up their prices, Amagi's profits could get squeezed. Simple as that. And speaking of profits, that's another thing to keep an eye on. The company only just recently started turning a profit after losing money for years. That's a pretty short track record of success.
So we've got a fast-growing company, but one with some pretty serious risks. That brings us to the final piece of this puzzle, and it's often the hardest part, the valuation. Let's try and make sense of the numbers.
And honestly, this is the exact spot where a lot of people can get tripped up, because the usual ways you might value a company, they don't really work here. And it's really important to understand why.
So if you try to use a standard price-to-earnings or PE ratio, it's going to look insane. We're talking a PE of over 600. It's basically a meaningless number because they've only just started making a tiny profit. A much better way to look at a high-growth company like this is the price-to-sales ratio. This just compares the company's value to its total revenue. And with its IPO price, Amagi is sitting at about 5.5 to 6 times its sales. That's a much more normal-looking number for this kind of company.
So, what's the final verdict here? Look, Amagi is without a doubt a really strong growth story. They're sitting right in the middle of a huge shift in the media world. But with all those concentration risks we talked about, and its very recent turn to profitability, this is definitely an investment for someone with a high-risk appetite. This is for investors who see those risks, understand them, and are making a big bet on the future of TV. And really, that's the billion-dollar question you have to ask yourself, isn't it? Is Amagi a core piece of the future of television, set to explode in value? Or is it a high-risk bet, where its dependencies might just be its downfall? That's the question at the very heart of this IPO.